No, Matt, I'm just going to start talking because yesterday I was live on the market recap for 30 seconds. Basically, could have been picking my nose the whole time. I have no idea if we're live or not, Cam. We are live, I believe. And Matt, go ahead and pop the screen up. Let's get our little intro here. And your system sound is not playing. We are...
Just give it a second. We'll figure it out eventually, T.
Welcome. Not a big deal. I mean, honestly, if that's the biggest problem I have today, I think I'm going to have a damn good day. Welcome out, Matt. And I'm excited to be here today. I got a lot going on in my mind. And also, we've got a trip later today where we're heading up to the Great Northwest and we're going to Seattle. So, trading is a wonderful thing. Allows you to leave when you need to, right?
Absolutely. I mean, it allows you the freedom to come and go as you choose. And you know what, Tim, the number one thing I'm most excited about today is watching Tiger Woods in the Open. I just absolutely love watching the majors in golf, and Tiger's off to a good start. Looks like a great Open this week.
You know what's amazing to me is I didn't even know the Open was today. Okay, so that tells you the difference in how I'm engaged in sports lately. I do know that training camp is starting, and I've got tickets to a Bears game in September for my birthday, so I'm excited about the NFL coming up.
How is that a birthday present?
Oh, I got to tell you, I love going to Soldier Field, and I love Chicago in the fall. There's no doubt about it. Let's talk markets here. Let's get down to business. First of all, you've got Amazon up because we were just talking about it, but it brings the question up of what's going on with the broad market today. You've got a little red doji candle, not a lot of pressure, not a lot of negativity. It's very normal for markets to have green and red and green and red. That's all markets. But how do you read this here, Matt?
I'm not taking anything in any capacity off what's happening today. In the news, you got anytime the market goes down in any capacity, and we're only down 0.28% today. We're only down 8 points in the S&P 500. But anytime we've seen this in the last month, anytime the market goes down in any capacity, it's always going to blame tariffs. And so if you go look at the news and you say, okay, well, tariff this and tariff that, and it's just in the news. But when I look at the actual economic data that came out today, earnings reports have been fairly good so far. We're still early in the earnings season, but earnings reports have been pretty decent so far. Today, economically, you had initial claims, which is part of the unemployment report we get every single week. And that had a drop of 8,000 initial claims off the expectation. So that was a good report. You had the Philadelphia Manufacturing Index came out, which was also a slightly positive economic report. So from an economics perspective, you actually had pretty decent reports today. I'm looking at this as just simple profit taking, Tim. You've had a real good upward movement over the course of the last 2 weeks. We talked about how it's up into its pay range. We looked at that yesterday, looking at this price movement compared to this price movement. It had a pay range somewhere around 125. It's already kind of driven to 115. So I'm not really taking anything big from the market, just taking a breather today.
We talk about market posture, and I usually put that in a numerical representation between -3 and +3, because that's what I was trained to do, a decade ago when I started learning how to trade. And right now I'm a +1, Matt, in the regard that I believe the market is slightly bullish and still continues to be so until otherwise noted. Are you on that same wavelength?
Yeah, I'm slightly bullish, but I'm also willing to turn that up a notch into a +2 if I start to see more economic reports come out that are positive. But I'm looking forward to the technology companies reporting earnings. You have Microsoft reporting earnings later tonight. You have a slew of them reporting next week as well. And so I'm kind of in that +1 territory simply because we have some major earnings reports coming out of the tech sector coming up over the next week or two. But if we start to see positive earnings reports out of those tech companies, I'm willing to go into that +2 territory. But again, I mean, when you're looking at the last month of the market, the S&P's up 3%, the RUT's up 3%, the NASDAQ's up 4.5%. It's certainly leading the charge right now in the NASDAQ. And so if we start to see positivity coming out of those earnings reports, I could certainly see myself going into that +2 territory. I mean, Google today, if we just take a quick look at Google today, got an upgrade in price from, it was either Morgan Stanley or Goldman Sachs. I can't remember who upgraded their price action, but it's breaking out of all-time highs. Microsoft has an earnings report we'll look at. It's at all-time highs. I mean, you're looking at a lot of those FANG stocks that have recovered nicely outside of Netflix, I would say. But yeah, I could certainly see myself coming into that positive too if we start to see some good price action coming out of earnings reports with those major tech companies.
You know, take a look at the other indexes because there's some interesting things going on with the Russell 2000 today. Start with the NQ. Obviously, tech has been the leadership in the market, and it's still on a little red candle like the ES today. So very similar to what we just saw. The YM is also very similar. Now, we'll come back to the RTY here in just a minute. Go to the Dow first, right up top. Yep. So the YM, very similar, little tiny red doji candle at the top of a range. Now, it's got a little different pattern.
I will tell you, I'm mostly concerned about the industrial index. Unlike the S&P that is breaking out of 2,800 and the NASDAQ here breaking out, and it keeps pulling up price action there, the NASDAQ breaking out of previous resistance, sitting at an all-time high. The Dow Jones has certainly lagged the marketplace from the broader index level. You have this, and this was Gartman's whole type of thing was it was going to break out of this range and run to 30,000. He doubled down on that today, by the way. But I'm a little concerned about the Dow Jones here. It's got an extended pay range that is typically a little bit over its normal. It's coming into that very strong trend line. It's got a small range candle, but that could form into some type of bearish engulfing candlestick pattern by the end of the day, which would certainly put a little bit more pressure. But even if the Dow struggles a little bit, you could still see those tech stocks rally.
No doubt. And then RTY, Matt, real quick, I want to show you where my head's at as well, is we saw a lot of the concern in the other broad markets, but then this one, cup and handle, could potentially break out, Matt. The small caps, the advanced decline line is showing strength today. The overall market breadth today is still fine. This week, it's been fine. I think Gino hit a few really, really strong points here in the chat. Unemployment low, economic data has been good, earnings have been relatively strong. The tax cuts have been, giving some incentives to these companies that they've been taking advantage of. Mm-hmm. Maybe the Russell is leading the way here. Maybe it's telling us what we need to see. It's not broken out yet, but you got to pay attention if it does.
It's certainly trying to break out. I loved your call on it. Nice little cup handle that typically leads to a breakout. If you're looking to trade it directionally, you're looking at trading it above the previous highs here, whether you put that at 1715, 1720, that's just a personal choice there. But if it starts running up above that, you could see price appreciate fairly aggressively, kind of like it did here in May and June. I think, Tim, in taco trading, we have this system called cash flow condors, where we do basically an iron condor system on the Russell 2000. This, to me, is the perfect setup to enter into the bull put side of the equation.
Really interesting market conditions. Let's move on to the volatility index. And as long as it takes Matt to analyze the volatility index, everybody go click the thumbs up button there on YouTube so that we can get some promotion of this video. If you're watching and enjoying it, give us a quick like. I like that as well. Matt, what's going on with volatility?
Nothing. It's price to buy still.
Yeah, it's down in the dumps. Nothing's going on here. Let's move on to the other commodities. Crude oil first.
Yesterday, go ahead, T.
Crude is an interesting one because I know that it's given us some signals that maybe you should be going long on. I'm still very cautious. I haven't touched it. You have a pivot candlestick here that at the beginning of the morning, Matt, was showing very real strength. It was at the high. It was green. It was looking good. And I left it alone. And one of the reasons I did, Matt, is I don't like the price action right now. I feel like this thing's got to churn through a few days and kind of settle in here. And maybe it'll be a little bit better next week when we settle into a different range. But those red candles create damage in the psyche. I can tell you for me personally, I have avoided a trade here because of them.
Well, I did go long this morning on crude. I felt like I kind of liked the price action initially coming into the day. I thought we could start to see a little bit of price appreciation. I'm a little bit concerned about it coming right back down. Let me show you kind of the intraday chart here and what I was kind of looking at. Right when it was breaking out of this range right here, Tim, that's where I went long. Okay. Now, when I went long on US Sol with call options is basically what I did. Swing trading US Sol, very similar setup. But I went long right on this. I love the price coming in, high volume, driving up, breaking out of previous intraday resistance levels. And now it's just retracing back down into those exact same levels. I still don't mind it right now. I still don't mind it. It's retracing back down into its intraday breakout point. If we start to see some upward movements above these intraday candle highs, you could certainly see that punching up against the highs of the day and potentially breaking out on the intraday. But it is really volatile today in the crude. It's got a big range on crude today. You're looking at a pay range from the high of today at 68.79 to the low of the day at 66.62. You're talking about $2.17 range on a $67 commodity. That's a big range on a candle. But the simple reality is, if you're going to trade crude right now, that's par for the course, Tim. The ATR on crude is $2.08. It's already moved $2.15 today. That's par for the course. If you're going to trade crude, you got to take the good with the bad, and it's volatile right now. I'm just going to hop off the fence, and I'm going long today.
By the way, a day trader would take that long setup on confirmation here within the next few minutes. It's a really interesting breakout, pullback, pivot. But I'm going to leave it alone. I got a flight later. I've already made my trades.
Mind you, I don't mind anybody staying away from crude today. It is really volatile. I like the price movement, but I could certainly see somebody else saying, I want to stay away from this. It's volatile. I get that. So if you're not into volatility, if you're not into quick movements, this is a stay away for you. I get that, but I like the price movement. I like the pivot. I like the fact that we're seeing this. Every time it's coming down, it's punching back up. The bulls are fighting here. The bulls are absolutely fighting here, and I want to fight with them.
I love what Gino's saying here. Matt, today's morning lounge, I bought and sold a call option on oil futures to show the members in the pro of tackle trading how I scalped in and out of it within 1 minute. That's really cool. That's obviously what we do in those premium shows there, Gino. And Gino's a coach over at Tackle Trading. Everybody in the chat say, great job, Gino. Gino loves pounding his chest, by the way, and I don't have any problem with that. When you make money, you should be proud of it. As a trader, that is something you build momentum on. Confidence.
Gino's been trading crude oil for years and years and years and years now. I remember, we were in a coach's show. This was years ago. We were in a coach's show, and crude was coming down, 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 and just getting hammered here. It was going from 107 down to 26, just going through an absolute bear market, getting absolutely slaughtered. And Gino, somewhere down into this 30 range. I was projecting it was going to get down into about the $20 range. And Gino's like, so what? Buy it now. I still remember that moment. He said, when I said, it's me and Gino in this coach's show, and I'm projecting it continually going down, 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 down. And I can't remember exactly where it was, but it was somewhere into here because it was somewhere between $30 and $40. And I said, no, I'm projecting it might go down to $20, somewhere between $20 and $25. And Gino's like, so what? It's a commodity. Sell a put option. If it goes down, you're going to buy it at $30. And if you buy it at $30, are you really going to make an argument that crude's not going to hit $100 again? I said, no, Gino, I'm not going to make that argument. And he says, well, then you do it now. And I still, it was one of the best trades I've seen from a position to an investing perspective as crude just started going on this juggernaut. And then over the last year and a half over there at Tackle, and everybody at Tackle Trading, every pro member can attest to this, we've been spot on crude throughout this entire run here from about 45 up until about 75.
I kind of want to find an old-timey country song, like they used to play before the John Wayne movies and whatnot. Gino Poor, he's the greatest trader in all the land. I don't know.
I'm not going to say anything to that.
I've got something in my brain. I don't know. I'm going to find
it. You got our dad in your brain right now. That's what you got.
Dude, don't you love those old, country musicians? Oh, I do.
No. We were sitting I was at your house on the 4th of July. We were having a barbecue. Mark was sitting listening to all this country music. I'm like, can we listen to something else? And both of you two were driving me nuts. But no, so no, I don't. But coming back, it's volatile. Expect that to continue. It's not for the faint of heart.
Sometimes you eat the bear and sometimes the bear eats you. I like it. Today, Gino hit crude oil well. Nice trade on that, Gino. Very, very good. Let's move on to the gold and metals markets. Matt, they're getting destroyed here. And we've been talking about this day over day over day over day. And I know that we have a lot of traders that have positions in gold. How much more pain could be here? Because you never know when you're going to get the snapback rally. And I'm sure people are hoping, but hope is not a trading plan. Right now, this is aggressively bearish. And there's many different reasons why. I'm going to make it simple. People are selling it. They're not buying it. There's not strong demand for the metal right now because they're looking at other investments as safer investment vehicles to put
the dollar is safer than gold right now. And I hate to say that, but it's true.
It is what it is. And so gold coming down here, could 1200 hold? Is that how you would be looking at this?
I'm looking at 1200 as a very strong support level right now. If we go back over some time and just look at kind of say the last 10 years of data here, you're going to see that this 1200 mark, look at as gold in 2012, 2013 was just getting absolutely spanked here. Look where it found support here at 1200. It retraces back up, comes back down 1200, retraces back up, tries to hold again. As you can see, you've got these downward pivots at resistance levels. That right here is, and let me just kind of point out here, that right there, downward resistance, downward resistance, downward resistance. That downward resistance level is putting a lot of pressure at that point on gold at 1200. But over the course of the entire year, Tim, from 2014 through 2015, or excuse me, 2013 through 2014, gold held at 1200. And so when it eventually broke it, but it did hold for quite some time. If you look at over here in 2016, once it got back above it, gold held support here at 1200, 1200, 1200. So you got a tremendous amount of data at 1200, a tremendous amount of data that is going back 5 years where 1200 has held and acted as a support level. So for the gold bugs out there, and for those of you that are investors in gold, yeah, I get it. It's been just getting its tail spanked week after week after week after week, once it broke 1300. But that $1,200 level is a significant support level that certainly could hold. That was my projection from last week. I said it yesterday, Tim, when you asked me my analysis on gold. I said, I think it's going to go down to 1200. And I still think it's going to go down to 1200. I'm not willing to project a break of 1200 yet. I'm going to let my eyes do the trading and not my heart or my brain. Don't get me wrong, Tim. I want gold to go up. I am a big believer in gold ownership, commodity ownership in general. The simple reality is, even though I said that dollar is safer than gold right now, it's based on trends and patterns in the short term. But if you look at history, gold has proven to be a safe haven for thousands and thousands of years. As currencies have come and gone and died and hyperinflated and you name it, gold has been that safe haven commodity. I believe in owning the precious metal, but I do not believe in losing money, which means when it broke 1300, what you should have done is you should have bought a put option on GLD, which would have been making money as it goes down, and you don't care about if gold goes up or down. But I am looking at that 1200 spot. My biggest concern right now is not gold, Tim. Okay, my bigger concern right now is silver. When you look at silver here, silver's just getting absolutely pummeled right now. Silver's underperforming gold, whereas gold is still above these previous levels of support. Silver is underneath those levels. Let's look at it from a 3-year weekly chart perspective. It is now coming into a support level between 15 and 1530. If it breaks 15, you can easily get down to 1360 to 14 fairly aggressively. Silver underperforming, gold underperforming, but if you give me my pick, I'd rather have gold right now than silver.
I think I'm going to plan a trip to the coin shop here soon, though, because when silver is that cheap from a longer term investing perspective, I'm much more likely to want to accumulate some of the actual physical.
I'm not looking to get rid of my coins, bro.
No. Hey, listen, do you even invest, bro? Right?
Yeah. Do you even invest, bro?
Oh, all right. The US dollar is breaking out. I know that we talked about the head and shoulders, but we kind of explained pattern recognition here the other day. And what could have been a head and shoulders developing now has become an ascending wedge, and now it's in an uptrend breaking out. Right. Mm-hmm. And I feel like I called this one here. And dollar strength is the talk in my mind of what the market's actually doing right now. You've got international money flooding into the dollar, away from other currencies, away from gold, staying in equities, right? And that's because of rising interest rates in the US and the tariff talk and everything going on. The dollar has upside potential here, and that is so strange to hear. But you know what? It is on the chart. You can't trade your emotions. I got to like it here, quite frankly.
Listen, if the projection on gold and silver is down, most likely the projection on the dollar is up. Now, in terms of this, I had this as a head and shoulders formation a week ago, and we talked about this yesterday when I was talking about, guys, even though you're projecting something, you have to say something has to happen before you make a trade. And what I said is it's got to break underneath this trend line. It never did. I never made the trade. Tim, you nailed this one. There's no doubt about this. Is it breaking out today? I don't know. I think it's got to close above 95.50 to officially confirm as a breakout. That's right now just 4 cents underneath that level. If it breaks out, though, this puppy certainly has the ability to run. It certainly has the ability to run. When you're looking at the last 3 years of the dollar, there's no real support level, resistance, historical level underneath 98. 95.50, it could break out and run to 98. Breaks out at 98, we're talking up above 100. And if you're getting up above 100, you're talking parity against the euro at that point. I remember back here, Tim, when we were looking at, when we went on this very, very strong bull run, you were talking about parity with the euro, and that hasn't happened for many, many, many years. I'm not willing to call that yet. Don't get me wrong. There's a lot of situations that could impact, but you got to love it from a technical perspective right now on the dollar. I'm thinking, like I said, I think the breakout for me is 95.50. If it closes above that, I would call that a breakout.
Yeah. Yeah. It's fascinating. And you know what, but it drives everything else we just looked at. Yeah. You could make a strong case that we should start the market skyline with the dollar and then go down to everything else. I mean, maybe, we could even have that conversation.
It's the number one trade in the world.
It's the number one investment vehicle in the world right now. And it has been for a very, very long time. Let's move into some individual companies that we've got in the news, Matt. And, there's a lot going on today. The number one thing in front of us is going to be Microsoft earnings. I want you to take a peek at that. And let's talk about this. The tech sector has led the market, driven the market, and we're at a high point right now. Moving into earnings. Earnings are tonight. How do you assess, the potential volatility? What would you want to see? What do you think here?
Well, the first thing you always have to assess from an earnings perspective is you got to assess what the market thinks the range of the gap is going to be on the earnings report versus what you expect the range of the gap to be. And we've talked about that in the past. How we assess the market maker move is very, very simple. We just go over here to the Analyze tab, and here's the market maker move. Now, Tim, you know me. I just think Toss has a tendency to make it a little harder. But what does the market maker move actually calculate?
It takes the implied volatility projections, which are based on the historical earnings gap. So, Matt, both answers are actually true. Yeah. So what it's doing is it's looking at the history. Market makers, when they price volatility, they're looking at the past to try to figure out what the future can hold, right? And so if Microsoft on average gaps, say, 3%, and last quarter it gapped 4%, the quarter before it gapped 2%, they go back 12 quarters and they figure out, okay, that's the projection. They're going to build that in the option chain with the Black-Scholes model. And over here on the right, that's right.
Which means this price right here is built into the value of the option.
That's right.
The market isn't going to allow traders to come in and buy an at-the-money straddle that just to take advantage of the earnings report, right? So they're going to build that number into the pricing model to offset the traders going in there and just buying straddles and strangles and so on and so forth. So this is built into the price action, which means your equation, the equation you have to come up with if you're going to make a trade on Microsoft coming into the earnings report is Microsoft going to gap more than the 3.3 points, or is it going to gap less than the 3.3 points? And Tim, you got to look at from a percentage perspective, not a dollar figure. Even though that's a dollar figure, you got to look at it from a percentage perspective, because $3.3 to or points to Microsoft trading at right now 104 is vastly different than right here when it was trading at $79, right? It's different from a percentage standpoint. So Tim, I'm going to give you the average gap from open to close, okay? Or excuse me, from close to open the next day. You tell me what you think in terms of if it's going to move more or less than the market maker move. So the first gap range is right here, right? We're just going to look, and I'm just going to give you just three. We'll do four, okay? So if I come all the way back over here to this one here, I'm going to have to get a little bit more time here so I can get four instead of just the three. There we go. Okay, so that gives me 4 right there. All right, so here's the one we expect. We're going to calculate 1, 2, 3, 4. So on this earnings report right here, from the open to the close, you're talking, or excuse me, close to the open, 74.22 to the next day, you're talking less than 1%, okay? This one here, it went from 78.50, we'll call it, to the open the next day at 84. You got a 6-point movement on an 80, so you're talking somewhere around 7.5%. This one here on the earnings right there reported after the market. So right here, closed 92.50, open the next day at 93.50. We'll just call that a 1% movement. And then on this one right here, okay, on the earnings, let's just get that one right there. On the earnings report, it moved less than 1% again. So Tim, 3 out of the last 4, the market moved less than 1% from close to open, right? On the one, you actually had a fairly significant price jump last November, and that price jump moved 7.5%. So 3 out of 4 moved less than the market maker, but on the one, it moved to substantially more than the market expected.
Right. And by the way, just to kind of try to teach this, Microsoft is not Netflix. Okay.
No.
On Monday, we talked about Netflix having the potential for a huge gap risk because of how fast their multiple changes. Number one, their PE ratio was sky high. They'd gone up 100% or something like crazy.
Microsoft is more Johnson & Johnson than it's closer to Netflix.
Well, quietly up 20% this year and also killing it. I actually think, you think about the FANG stocks, people are not talking about Microsoft as much as
Microsoft.
I agree. I mean, Microsoft is a more important company in my perspective, in that opinion. It's an $800 billion company, Matt.
It's a massive company.
I don't think it's going to gap 10%. I just don't. I don't think it's going to gap 5%. If you pin me down to 3%, which is a very efficient line, I'm going to say under, but I probably still am not going to trade something short volatility in that regard. I don't have a position on Microsoft yet. I ran the numbers for a condor, for a short strangle, couldn't make it fit what I'm looking for personally. So it's kind of one of those probably going to pass on it type of deals. You could do something.
You could go out all the way to September, okay, sell a 16 delta $95 put option. Combine that with selling a 115 call option, right click, sell. We're doing what's called a short strangle. We're selling volatility here. So we're selling the 95 put. We're selling the 115 call. You're getting about 159 credit on that versus a margin of 1100. 159 credit for a margin requirement of 1100. You're talking somewhere around, what is that? 17, 18%, Tim?
Yeah, but you ain't going to make 17 or 18%.
No, of course not. You would make 3 or 4%, right?
That's if you held it for a week and the volatility stayed in the range. Here's what I always think about when it comes to short strangles personally, Matt. If I don't think I can make 2 or 3% tomorrow, I don't want to do it.
I think you could make 2 or 3% tomorrow on. If Microsoft stays within its range, 3% from 0 to 3%. Volatility gets crushed coming out of the earnings. You could definitely project a 2 to 3% off that 18% probable. Yeah. Now, whether you do it or not is your personal taste. I'm just saying I could understand the trade. I am not going to make this trade, right? I'm just saying I could understand another trader saying, yes, I like that. I mean, Tim, you're selling all the way up here. I mean, you're selling the 115 call up here, and you're selling the 95 put right there. The expected gap range is right here to right here. You're selling much more than twice the expected gap range on that bad boy. You're selling about 2.8 times about 2.8 times the gap range. I could definitely understand a trader saying, yeah, I think it's going to stay within this range.
I can't fault somebody for taking the trade. I don't have a position on it yet because I still have not convinced myself that the logic is there in that regard. I prefer big mega cap companies. I will tell you this. And one thing I like about this trade is that you've got 3 market maker moves in cushion. Okay. Earlier in the chat, Michael was asking, well, why do you have those probability cones? Just to project out volatility ranges, is all. 10 points up and down. we have one gap that is really throwing me off of this whole position, Matt. That's 4 quarters ago or 3 quarters ago. Go back a little bit. I want to show it to you. So there's one report that is made me to where I'm not actually pulling the trigger on this yet. See that gap last October?
Yeah.
Started at 78, gapped up to the high point. Actually, the high point mark of the candle was at 87. $8 move. If technology, and this is the leading company for tech stocks, we don't have any other information from the Apples and the Googles and the Amazons yet, Matt. Yep. So I don't know. I just am leaning on the side of caution. You know,
I totally understand. I totally understand that. I most likely will not make this trade because you and I will be in meetings all day and we won't be able to manage the trade. So, yeah. But at the end of the day, I'm just saying I could understand a trader saying Microsoft 3 out of the last 4 times capped basically 1%, which that short strangle, if Microsoft does nothing tomorrow, that short strangle would be rock solid. You're not making, 2-3%, Tim, you're making 4-5% at that point with volatility crush. So
now let's ask our audience here. Let's poll everybody. Guys, would you sell volatility here, buy volatility, or pass? Sell volatility, buy volatility, or pass. It's a tough call. I think traders, that's why it's so efficiently priced. It's really an efficiently priced volatility projection right now. Interesting. And by the way, at 25%, you're right in the middle of your implied volatility range. It's been as high as 30. It's not the highest point it's ever been. It's an interesting one. Yeah, interesting. All right, let's move on to a couple other companies. We can kind of check those Microsoft ones. One I want to look at, and a really interesting stock today, is Disney. Disney did not have planned news, Matt, but they came out and broke out. Actually, it wasn't Disney's news, but it's a really good breakout from a long-term perspective. When you're having a trigger off of a range from 8 months ago, do you still play that as a breakout?
You can play this as a breakout. I mean, anybody who has been watching our podcast, Market Skyline, or coaches shows, you know me. I don't love breakouts after an extended run. I don't like them. You can, you obviously have an extended run here. If you're looking at, the ATR to kind of help you understand that, not the ATR, excuse me. If you're looking at the RSI, which is the relative strength indicator that helps you kind of understand, if a stock can run even more, your RSI is currently at 84, well above the 70 barrier here. You've already ran from 104 all the way to 113. That's a nice little 9-point movement. Disney doesn't have that ability historically. In any of these price movements, Disney is overextended coming into the breakout, but you gotta love the news. And it wasn't even Disney's news. It was Comcast. Comcast came out and said, we're no longer in the running to buy Fox, which is basically all of, it's all of their Hollywood studio videos and stuff like that. It's like a $70 billion merger. So Walt Disney is, basically the only one out there going to buy Fox. And it's just going to give Disney an arsenal to go out there and create even more great movies. And Walt Disney is a great, great brand name, no doubt about that. Positive. Now, the positive I'll take away from this, though, is it is breaking out of a 52-week high. What I would expect Disney to do, though, is kind of fade up into here, forming a little bit of a high base coming into its earnings. I don't think you can make a play on Disney one way or the other in front of their earnings after an extended run here. I think you wait for after the earnings report and then make an assessment.
I'll tell you this, if it was not on your watch list before, I think you got to add it on right
Absolutely.
Now. Higher pivot high, higher pivot low, higher pivot high, higher pivot low, new breakout point, higher pivot high. Got to like it. Very interesting. There's 2 candidates actually, guys, that I think are good trade ideas here today, and I want to go through them. The first one I want to look at is XLRE. And by the way, on the weekend, we always put out our premium scouting reports over at Tackle Trading, where we give about 10 or 15 different candidates, in the stock and options market on how we play stuff. And a lot of it is just based on, short-term swing trading, position trading stylings. And XLRE, Matt, is a beautiful setup with a beautiful confirmation candle. Even as we've been speaking, it's up a little bit more here today. I went long call. I don't usually go long call. I'll tell you that. I'm not a big speculator when it comes to straight option plays, but I went long call about 30 cents ago, and I'm liking it.
Well, we analyzed this yesterday pretty thoroughly. And I basically said that it was sitting at support, small body candle, any upward movement in price tomorrow. This is a perfect trade setup. I love this trade setup.
The only thing wrong with this chart right now are all those percentages you have on those red lines.
Those percentages are the reason why I call the exact bottom on XLRE. So the reason you're making money today is because I put on these red lines. Okay, you wouldn't have made that call option if I didn't analyze this yesterday. So you should say thank you, Fibonacci. In fact, I'm not going to analyze this until you say thank you, Fibonacci.
Moving on to Netflix, just go ahead and put Netflix up on the top left.
Oh, come on! You made some money off of it. Come on, give Fibonacci a little. You got to agree that Fibonacci retracements are still a popular.
All right, not everybody's heard my rant. Let me explain my rant. Bad traders who don't know what the hell they're doing use Fibonacci to try to explain logic that they don't actually have. They don't even know how to explain it to other people, and then I don't even think that is my rant. That is my rant. It's poor technicians and poor traders who don't actually know how to trade. They mirror it with Fibonacci.
I don't think that's your issue.
Smart.
I think
it is my issue. It's always.
I think your issue is bad educators who really aren't very good. That they use Fibonacci as a way to show how smart they are. I think that's your issue. I think you're biased. That's what I think.
Let me have a little micro meditation here and find my Zen. Moving on. I can't get emotional during a trading day here. I've got money to be made. All right. Okay. It's a good trade. Thank you, Fibonacci. Good analysis, Matthew. I appreciate it. All right.
That was his way of saying thank you, Fibonacci. That's what that was. Okay, let's analyze this though, and this is why I love this setup. We analyzed the support level yesterday. It was coming into a previous pivot line. It was sitting in between two rising moving averages, sitting at the bull area. It was sitting at a 50% retracement on the Fibonacci. That's why we like the trade. Now, now for those of you watching, whenever you're looking at a trade and you're looking at potentially making a trade, you just don't go out there and buy call options. That's not what you do. You prep the trade first. Okay, we got to set up the trade and you got to identify, okay, where's your entry point? I got no problem with somebody just saying right now, we got a great pivot candle, let's go buy right now. I got no problem with that. So the entry price is already kind of taken care of, that we have a good upward movement in price. For the advanced trader, the overanalyzer, the analytical individual who wants to go look at 5-minute charts, 1-minute charts, 2-minute charts, they might say, you know what, I want to wait for a little bit of a retracement back down. That's fine. You go miss the trade. We're just going to go pump some call options on this one. Now, so our entry is kind of taken care of because we have a confirmed candlestick pattern right now. The second thing you have to do is get your stop loss. Now, there's a lot of different stop loss techniques. You know, you can do 1.1 times the ATR underneath the low of the day. You can do a trailing stop loss. My favorite stop loss is what I call the "what if you're wrong" stop loss. So I want everybody in the chat type "what if you're wrong." Okay, everybody say "what if you're wrong" there in chat. And if you're liking the video, make sure you give it a thumbs up as well. So what if you're wrong? The entire reason, Tim, that I projected it going up was because I thought this previous pivot and my Fibonacci level was going to hold. So if it doesn't hold, that's when I'm wrong. I'm not wrong if tomorrow it comes down a little bit. I'm not wrong if in 2 days it comes down a little bit. I'm not wrong even if it comes to 3250 because it's still above the reason why I wanted to get into the trade in the first place. And so you got to give that a number. Tim, I'm going to give that number at 32.25. Once again, 32.25. Now, my favorite stop loss on a swing trade is a 50% of the ATR underneath that level, the "what if you're wrong" level. So if you're looking at the ATR right now, the ATR is, we'll just call it 40 cents. 50% of 40 cents, that is 20 cents. 20 cents underneath my support level of 32.25 is 32.05. So I'm going to put a stop loss at 32.05, which is right down into this range right there. So I got a little bit of cushion. I think one of the biggest mistakes new traders make, Tim, is they put too tight of a stop loss because they don't want to take the risk. If you don't want to take the risk, don't make the trade in the first place. That's the equation. Yeah. So I want to give myself a little bit of range. I'm giving it 1/2 ATR underneath this support level that I have at the previous pivot right here. So let me kind of draw that box right there. All right. So here's my support level. I'm 1/2 ATR underneath that. Now, my favorite targeting technique, and there are many of them, extended Fibonacci levels. We won't draw those, Tim. Actually, I might draw those just to upset you. But in terms of this, my favorite one.
I don't mind the extensions, actually.
Retracements are so much better than extensions. Extensions are the worst part. What are you doing? You know what? Would-haves and should-haves and could-haves. Would-have, wouldn't. Yes, no. What? Get off the fence. Seriously.
Listen.
Okay. Anyways, I
love this analysis because you have a stop loss. What if you're wrong analysis? You know how often I see traders holding far beyond the original trading premise? Guys, this trade is proven to have not worked if it goes below the pivot.
Oh, well, here's the thing. If you don't put that stop loss, here's what's going to happen. Okay, here's what's going to happen. It's going to come down. It's going to hit that level, and you're going to say, oh, but you know what? It's got the 50-period moving average right here.
Oh, yeah.
And it's going to bounce off of that. And then it's going to come underneath that level, and you're like, oh, but I was really right on that because, look, it's got this previous support level down here at 31.30. You're always going to make a justifiable reason to stay in the trade. So just put the stop loss in. Just put the stop loss in. And then you don't have to worry about making emotional, psychological decisions when your emotions are high. Because when your emotions are high, that's when we don't make logical choices. We make irrational choices that are not based on numbers and math and whatnot. So just put the stop loss in. But what I was saying was my favorite targeting technique is a technique that one of our mentors, Noah Davidson, myself, Tim, one of our mentors taught us. His name is Jeff Crystal. And Jeff, back in 08, 09, who is one of the most analytical individuals I've ever known in my life and an absolutely amazing trader. Jeff, we were sitting, it was Noah and myself sitting in a room with Jeff, and we were doing some type of back testing. I can't exactly remember the exact setting, but Jeff had me and Noah start analyzing some stocks. And we were projecting based on Fibonacci or trend lines or whatever it was. And he said, it's simpler than that. The most accurate targeting technique is just the average of the previous two price movements. And it took into account a little bit of Elliott wave, a little bit of Fibonacci. It extended it a little bit, but it's really kind of simple here. When I'm looking at my previous two price movements from the higher high to the higher low, it goes from $30.50, so $30.50 up to that breakout, up to the resistance level, which is now the new support level of $32.25. So that is a nice $1 and is that 175? Yeah, $1.75. The next one goes from right here at 31.25.
Just to keep track of the math and help people learn. In the chat, guys, put in R1 1.75. R1 equals 1.75.
Range 2 goes from 31.25 up to, we're just going to make the math easy, 33.25. So 31.25 to 33.25 is a $2 range.
So now R2 equals
R2 equals 2, range 2 equals 2. So Tim, you're looking at right about $1.88 potential average yield. And I want everybody in the chat write PAY, P-A-Y. It stands for potential average yield. It is the simple understanding of range 1 versus range 2. That equals $1.88. So from my support level, Tim, at 32.25 plus the pay range of 188, you're looking at a potential price target up here at 34.13. That's my target, 34.13. The return is greater than the risk. My risk right now, if you're looking at getting into the trade, 32.94, you're talking somewhere in stop loss. What was my stop loss, Tim? 30.05. 32.05. So you're talking 90 cents on the risk.
Mm-hmm.
And you're looking at 34.13 minus the current price, 32.94. You're talking $1.19 on the potential return. You got a positive return versus risk ratio. The only thing that would stop people from making this trade is some traders would rather have a 2-to-1 reward to risk ratio, which would not meet that standard. I like it. I like the probability of it. I think it's a good trade.
Yeah. Yeah, and you could logically tighten the stop loss up a little bit to that candlestick low. 50% of the ATR is fine. 10% of the ATR below the candle is also another technique I like. Even it's funny, how things work in swing trading. You got to be very sharp. Even getting the trade 20 cents ago would have had 20 cents less on the risk, 20 cents more on the reward. It throws the reward to risk ratio in a positive
Oh,
favor.
Tim, if we want to analyze this at the first of that tackle trading halftime report,
Yeah.
instead of right now, you're talking about, what is that, 15 minutes? So we're talking right there. You're talking about 73 cents on the risk.
Well, I got my trade stamp here. My time,
Versus,
I got in at 10:18 in the morning, my time.
so right about the time okay. So what was your trade stamp? What was the price?
I paid, well, 10:18. I played the call option straight, 10:18.55. So if I'm looking at the
About 32.75.
yeah. So
About
not
32.75.
that big a difference, you'd think, but
No, it
it
is a
changes.
big difference
Yeah.
because
Yeah.
it's 20 cents additional return, which would make your return now 139. It's 20 cents less risk, which would make your risk 70 cents. At that point, you have a 2-to-1 reward to risk ratio, and that's a much better trade. Timing is very important in trading, no doubt about it.
Timing matters. There's no doubt about it. That's where Netflix comes in next, Matt. Actually, a good pivot trigger candle today. I nailed this. I will say that. I think you also
We're having an argument on
we
that
had
one.
a debate about this. There
We
is
had a
video
pre-production
replay.
argument about who nailed this one.
Listen, candlestick, backfill, 380, pivot, trigger, confirmation. Beautiful setup for a bear play. Now, it's an aggressive directional play. There's no question about it, but this is the kind of stuff you do in trading. I like a bear put here, Matt, is what I was looking at. I don't know what you're seeing.
I'm definitely projecting down. I'm definitely projecting down, maybe back down into the gap range of 344. I thought this price movement was completely over exaggerated. Thought it was completely over exaggerated. I'm looking at here, if you take the earnings out of the equation, take the volatility out of the equation, you're looking at an M formation, retrace back up into resistance. That's called the kiss of death, ladies and gentlemen. And based on this, to me, I think it's going to come back down in price. Now, obviously, Netflix can do this. There's no doubt about it. Netflix can do this. This is a big boy trade, right? XLRE, anybody can make that trade, pretty conservative trade. If you don't have a thirst for risk, you don't trade Netflix in the first place. But I loved what you said, Tim, in terms of exactly how you're going to go about looking at this trade. Instead of just going directional, put options by buying that 0.61 delta there and spending 4,000, what would that be? 4,000.
Close the option chain. I'll show you a simple thing to look at. Okay. Go back to XLR real quick. And I'll show you the difference. I went long call on XLRE, and I don't normally do that. But if you read the volatility numbers on the right, Matt, 14%, 14% implied volatility. That's like in line with the VIX. It's dirt cheap options right now. You look at Netflix, and we're still at 35, 40%.
Yeah, you're
a lot higher.
You're
now,
still paying premium.
Netflix is always going to be higher than an ETF. There's no doubt about it. But I still think the volatility is a little high compared to coming off of an earnings report. You might still see some vol suck out of that trade. So that's why I like the spread.
Well, there's a couple ways you could go about doing this. If you wanted to be a little bit more aggressive, you could do something like a bear put spread where you're coming in here and you're buying the 375 put option, the 0.50 delta there. Okay, so let's go to vertical here. So you're looking at buying the 375 put option here, selling perhaps the 325 put option, 330 put option. You pick poison. We'll do the 325 put option. Lower your cost down to about $2,100 in that capacity. I like that trade setup. It's much more of a conservative type of a trade where, looking at your potential risk profile would be a lot better in that capacity than just doing a directional put option. It would lower your risk tremendously. That's why we like doing the spreads. I also could understand with the volatility still being fairly high, maybe coming to a range where you don't feel it can get back up above, coming to the analyze tab, looking at 450. Okay. So I got 420. Let's go. I'm looking at the wrong one. We're looking at 64 days out. So I could come here to 29 days out, maybe get back up above that 420 to sell that 420, see what kind of credit we could get here. Yeah, you couldn't get much. Couldn't do the credit spread.
I don't like the bear call here. I have a concern about the bear call. See, the debit spread, I have a positive reward to risk ratio, and it's a directional aggressive trade. So if I'm right, I want to get paid on the deal, right?
Yeah.
Where the bear call spread is more for passive cash flow, and I love cash flow and theta trading. I mean, that is the core of my philosophy in trading, the way I teach people. But for whatever reason, I feel like that Netflix has just too much risk that to have a rip roaring trend to the upside if I'm wrong on the condition. And by the way, how you manage risk is what makes you a trader. Okay. You know, it just is. How you manage the risk is what makes you a trader. And so for me, having a debit cost where I know exactly what I can lose if I'm wrong, and if this thing just rip roars to the upside and just takes out those highs, I'll be wrong. At least I know what my risk was, right? Does that make sense?
Yeah, I like the bear put. I like the bear put debit spread here. I think that's the best way to go about it. But once again, it's going to be a tough trade to manage. Your stop loss has to be above 380. You're getting in at 366. You're going to have some risk there, even on the debit spread. So unless you're a veteran out there, trader who's done this a lot in terms of debit spreads, it's a stay away for the new traders. But I do, from a professional standpoint, I could certainly understand somebody doing a debit bear put spread. I like
Guys,
that.
If you're loving our daily YouTube show, I appreciate you being here every day. Find that like button. It does help our analytics. Those of you who know how Google and YouTube and all that stuff works, somebody's explained it to me that the more it's liked and commented on, other people will find it. And I want a lot of people to find us.
And share it. If you like it, guys, share it with somebody else.
If you can
tell somebody about it.
Click that share button. We'd love to have you do that. That would be awesome. We're looking to build something really awesome here and bring value each and every day. Netflix, XLRE, that's plenty. The only other trade I made today, and I don't want to go through it, it's a complex advanced trade, is the RUT Iron Condor I built for the 60-day option. If you did not see the replay on the Cashflow Condors Mastermind group, Coach Tyler Craig and I last night, we talked about the September bird. We had it take flight today. It's a wonderful cash flow system. Go check the replay out on tackletrading.com. It's a wonderful webinar we did on that. Matt, last thing I want to talk about, simple, is I had a question in Cora I could not help myself but answer. And Cora. I love Cora. I usually bring Cora up to annoy you because people ask dumb questions, but this wasn't a dumb question.
No, it was actually question. It was a great question. Cora drives me nuts because, basically what you just said. You just bring it up to annoy me, but this was a great question. And Tim, the question was basically this. Over the last 19 months, I'm up 8% in my 403B, right? Mm-hmm. And the market's not up 8% in that time frame. And basically the question, and Tim, let me get the actual question.
But let me ask everybody in the chat here, what kind of retirement accounts do you have? 401k, 403b, IRA, none? Because this person asked about a 403b, which is usually given for a government employee, nonprofit, something like that. Most people have a 401k through a corporate entity. Many people will have an IRA or some combination, right? But a lot of times they're very similar if you're just putting them in mutual funds.
Yeah.
So same answer to all of them.
So here's the question. And, Tim, I tweeted this after you came out and said it, but, it's amazing that you take your time to answer people's questions that you don't even know. And I looked at some of the other answers and they're just blah, 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 but you took your time to answer this question. I think it was really, really cool of you. The question was this: why has my 403B only earned $492 in 19 months with an $8,400 in contribution? It says 7.79% personal return, but it seems disappointing. Okay. First of all, you can never just say a number is disappointing. That's number one. You always have to compare it against the indexes and what the indexes are doing. If you're doing 8% and the market's only doing 2%, I would say you're doing absolutely fantastic. If you're doing 8% and the market did 19%, I would say you're doing bad. So you can't say one is good versus another. You have to always compare it against the barometer of the market, number one. But the question is this a good rate? And Tim, you went through and answered it like a pro, but talk about kind of how you answered that.
Well, There are four basic cornerstones, in my opinion, to personal finance. And I know that one of them is very hotly debated, especially amongst investors who know better. But I want you to think about the broad person, just the average person, when we got started, right? Mm-hmm. Number one is, I believe you've got to live within your means. You can't just excessively spend money on crap you don't need. Okay. You can't just go out and buy everything that is on your wish list with credit cards and buy that new big screen TV all the time. You've got to live within the means that you are providing right now. You can live an amazing life. We live in America. You know, we live in a time where the standard of living is higher than it's ever been in the history of the world. We've got iPhones. We're streaming on YouTube. You got an amazing life in front of you. Don't spend on stuff you don't need, right? So and I don't like the word budget, but having some discretion over consumerism, right? That's number one. Number two is to save money. Now, Matt, I know a lot of people, they dispute this concept about saving money, but the average American has $1,000 net worth at 40 years old. Most people could not pay for an emergency with the cash they have in their savings account. There's a problem. There's a financial problem in this country with financial illiteracy. And until people can at least save enough money to cover 3 months of expenses, I mean, to me, that is right. That is a common sense thing to do.
The number one problem for me in America, there's a lot of problems from an economic perspective with the debt implosion and how much money we have printed. But from just an understanding perspective, from a financial perspective alone, the number one problem is financial education. We do not teach financial education. And because we do not teach financial education, people don't understand good debt versus bad debt. They don't understand balance sheets. They don't understand revenues versus liabilities. They don't understand the tax code. They don't understand what a 401k, 403b is, what a 527 is, what a TSB account is. They don't understand the difference between a mutual fund and an ETF. They don't understand how many fees they're getting charged. The simple reason that this gentleman is doing 8% versus what the market did, Tim, as you can see on the chart, 19 months ago, was back in November and December of 2016. This was right after the election of Donald Trump. And the market roared for a straight year. Did nothing but go up, 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 up for a straight year. The tax cuts came in November and December last year, roared again. Even with the stagnation we've seen year to date in the S&P 500, the market's up 22% since that time frame, Tim. 22% since that time frame. So when he says, this individual, I don't know if it's a he or she, but when they said that they were only up 7.8%, and it seems disappointing. Well, it is disappointing because you are getting just absolutely slaughtered in mutual fund fees. You have to do what Warren Buffett said. He said this many times, but I remember he gave an interview to Moody's in, I want to say October of 15. And he said, instead of buying mutual funds, just buy the market index itself or buy an ETF that tracks the market, like we're looking at right here. When you're looking at a mutual fund, Tim, you're looking at multiple different fees, and those fees don't even have to be told to you. They don't even have to be disclosed to you. And that to me is a crime in and of itself, except that there's hardly no regulations on Wall Street and the financial institutions. You're paying an average of about 6 fees in a mutual fund. So the reason you're up 8% versus 22, your financial advisor has a nice Ferrari sitting on some beach house in Manhattan.
Yeah, it's true. I mean, and we're not, first of all, this is not an original idea. This is Warren Buffett and, all of these
John Bogle, the founder of Vanguard, has said don't buy mutual funds.
That's right. So, learn how to live your life and move it forward with positivity, obviously. And I did commend the person for investing. I mean, they're contributing to something. A lot of people don't do that. I think it's great that they're trying to go somewhere, and then they've identified a problem, so they're asking a question. Now, the next step is to come up with a solution, right? Yeah. I mean, there are countless numbers of people out there. See, what we did on Netflix and XLRE, that's trading. But even just proper investing, learning how to, that's 3 and 4 is learning how to properly invest, finding an ETF, a low cost fund, parking your money in there, learning how to control it. If you can add the covered call and a hedge or something like that, you're great. You're doing amazing things. Your account in the last 19 months should be up about 25%. It should be. If it's not, you've not performed with the market. Now, the question that I think anybody should have is why? What are they doing in my portfolio? And Matt, one of the number one things is fees. The other thing is composition. And they don't really put a lot of thought into this. If you're in a 403, 401, you probably have some solutions that you can develop. And one simple thing that I'm going to recommend is to get a list of ETFs like this one right here, Matt. You know,
well, all I'm going to say is if that individual who asked the question on Cora was a pro member of tackle trading over that same time period, they would have a lot better situation. You know, it's very sad, and I'll just end on this, Tim, a little bit of mindset. It is very sad to me that we will send our children to school for up to a decade to learn how to be a lawyer or a dentist or a doctor. They will go into debt hundreds and hundreds of thousands of dollars at a fixed 7 to 8% interest. But then those same individuals scoff at financial education and financial literacy. That's the biggest problem. It is a mindset problem. We have to overcome that. And that's why I'm so thankful to all those pro members over there at Tackle Trading who believe in the same things that we do.
By the way, on our Twitter, there's a "Do you even trade, bro?"
I saw it.
I don't know who that is. Who is that handsome gentleman?
I don't know. Good job, Kim. Good job. I saw that. I saw that too. Good job, Kim.
Hey guys, who's having more fun than we are? You know, get control of your finances, learn how to trade, get control of your life. Love having you guys here. Matt, we got a flight we got to catch here in about 2 hours. So I think I've got to start prepping and actually 2.5 hours, I think, but yep. I've got to get ready. I got to get my bags
packed. For those of you who are not a member of Tackle Trading, get over there to Tackle Trading today. You can sign up for free, hitting the Start My Trial. You can also, that will automatically be put into the Tackle Today email, which is our daily email updating all of you guys on everything we're doing, from webinars to live trading rooms, to scouting reports, to blogs, to everything on a daily basis. It's a great way to keep in touch. Thank you to everybody who attends this on a live, and thank you to everybody who watches this on replay. That is absolutely amazing. We love you guys for that. Thank you for sharing this with other people. Thank you for liking it. Thank you for being the best part of Tackle Trading. We'll see you guys next time.